But hey, thanks everyone for coming along. So I'm Miles Stouty, the Portfolio Manager for the Global Value Fund. Here with me is the lovely Emma Davidson, who's also Head of Corporate Affairs. In terms of today's update, I'm going to ask Emma to start off with a little run through of the company. And she will also talk about how we have recently changed countries and have recently immigrated to Sydney full time. I'm going to spend a little bit of time talking about markets in general and how the portfolio is positioned for that, hopefully. And then finally, and I think one of the things that Jonathan alluded to, as a business, we've been growing quite a lot in the last few years. We've made some very important hires. One of them is a chap called Mark Ambrose in London, very senior hire for us, and he's recently just joined the Saudi Capital Board. And I think one of the wonderful things about that, having people like Emma and Mark around, is that I can step back a little bit and spend a little bit more of my time investing and focusing on the things that I enjoy, but hopefully the things that add the most value for the Global Value Fund and our other clients. So Mark's going to spend a bit of time today running through a case study with Emma. Because of the time zone difference, we didn't want to drag him out of bed at 2 a.m. So unfortunately, we've pre-recorded that a little bit, and that will be at the end. But without any further ado, I'll hand over to Emma.
Thank you. Thanks, Miles. Hi, everybody. Thank you so much for making the time today. As Miles said, I wanted to literally spend 5 minutes just talking about the company and where we're at. GVF is in good shape. The company has started FY 2023 off well. The portfolio is up 6% in the first 4 months to the end of October. And our annualized returns since our inception in 2014 are running at about 10% per annum, 9%, and that's net of all fees and costs, just to be clear, 9% of that growth has come from the discount capture strategy. So it's doing well. Many of you will know about GVF, but I've got a few people who are thinking of rejoining online. And for those who could just do with a reminder, I'll spend a moment just talking about what it is we're doing for you, our investors, in GVF. We have a differentiated strategy at GVF. We're not stock pickers. Instead, our core skill set is an ability to unlock value in the investments that we make across the world through a variety of different techniques, including catalysts that might be in place already, or indeed shareholder activism. Our stated aim at the Global Value Fund is to target global share market-like returns, but to do so with a much lower risk profile than a traditional basket of international shares. Essentially, we're aiming to be that steady Eddie in your portfolio. We look to provide investors with 2 sources of return. First, the source of return that comes from the assets and the currencies that we end up holding within the portfolio. And then secondly, the returns that we make unlocking the discounts that we purchase those assets at. And that's the way we achieve the lower risk profile, is through the diversification of that first kind of asset class. Most of you will be familiar here with the pie charts that we update in the monthly. But if not, what happens here is typically we're only ever invested partly in global equities, then we'll have some debt, and we have a very diversified basket of assets that we've purchased all over the world. Because of that, by investing globally, we also end up holding a basket of currencies. And again, the main aim with the basket of currencies that we hold is to largely reflect the global investable universe. And to stick to developed market currencies to bring in that all-important diversification. Now, the underlying assets on the left-hand side and the underlying currencies on the right-hand side make up a pretty unique, conservative, and dare I say it again, diversified basket of assets, which really drives down the risk at GVF. Just to be crystal clear, if we were to attribute out what the assets have done since we IPO'd and what the currencies have done, it would look like this. So that first grey chart or bar, if you like, is what the currencies have done since IPO 8 years ago. The lighter grey on top there is what the currency basket has done. Oops. And what you can see there, hopefully, is a low risk, low return type portfolio. You know, over the 8 years, the currencies and the assets have produced 5 to 6% per annum, which is what we would expect for a low risk portfolio. The way GBF then targets those higher returns than that 10% that I mentioned is we strap on top all of the discounts that we unlock doing what we do around the world. And this top navy line shows the net returns that GBF has achieved since the IPO, 8 years ago. Now, probably the most important tool that we use to ensure that shareholders directly participate in the returns that we generate is we aim to pay out most of all of our investment returns as dividends. This chart here, in fact, I think, we just paid $5.1 million to investors just under 2 weeks ago in the semi-annual dividend that was declared. So it gives you a sense of the quantum of amount of money that we pay out to shareholders. This graph hopefully illustrates that consistency and reliability of the 8 to 9 cents grossed up annual yield, dividend rather, that we have paid through time. Since IPO, investors have received back 66 cents on their initial $1 investment. And we have 24 cents in the profits reserve, which is the next 3.5 years of dividends covered. We also have around 8 cents in the franking, so we have a good amount of franking. And obviously, if Mars continues to make more money for us in FY 2023, we'll have even more franking. So we're in good shape from that point of view. One last graph for me, so I can stick to my 5 minutes. And this is my favorite graph. I show it most times. Look, it is. And the reason I show it is because I believe it really shows the skewed risk profile that GBF runs with. On this graph is every single trade that GBF has ever done. And on the left-hand side is the profits that GBF has produced. And on the right-hand side, if I don't get a thumb spasm, is the trades that we've either kind of not made money on or made a loss on. And I love this graph because of the high win to loss ratio and the fact that when we do make money for investors, we make money. And when we lose money for investors, we don't lose as much, which I think when discussing one's pension assets is what people want to hear. We will continue to stick to our knitting of ruthless risk management whilst maintaining that 9 cents grossed up dividend on an annual yield. And I'll hand over to Miles to talk about Miles.
So, quick poll, is it better without the microphone like me or with Emma with the microphone? What's the microphone's better? Okay. Hello? Hello?
Hello, Mars.
Hello, Miles. Yeah, it's good. Is it green?
It's green.
Good.
Unfortunately, I'm red-green.
He's red-green colourblind.
Red-green colourblind, so I'm pushing today.
Is it definitely working? Do you want to take mine?
It's working.
Is it working? Okay, great.
Thank you. Will I do that?
Up to you. Yeah.
You want to swing it around?
Yes, okay.
Yeah, it's a bit sticky, isn't it?
Oh, yeah, the neck. Okay, there we go. So thanks, everyone. Just a few words from me today on the market outlook and hopefully, importantly, how the portfolio is positioned for that. And I think just to start us off, I mean, the key issue with markets today continues to be inflation, which is a problem we haven't had to worry about for a very, very long time, but is a serious problem that's at the forefront of markets' minds today. And the problem with inflation, now that it's back as a serious market problem, and just to frame how much of a challenge it is, in most rich world countries today, Australia, the US, France, the OECD, inflation's running between 7 and 11%. So sort of eye-watering numbers we're certainly not used to. The problem with inflation like this is that it's a very hard economic problem to pin down for policymakers. And that's because, and this is a theme Emma and I have talked a lot about, it's as much a psychological problem as it is an economic one. The more of us that think inflation in the future is going to be a problem, the more it actually becomes one. We have this expectations feedback loop. The more of us that worry that the cost of living is going up, the more of us march into the boss's office and demand a pay rise. The more of us that do that, the more companies have to increase the things they sell their products for, and it's self-perpetuating. The cost of living goes up, and you sort of rinse and repeat. Emma and I did a roadshow in March where we talked about this expectations problem. And in that, we set out our concern with the markets thinking about inflation. And I'll summarise that sort of as quickly as I can. But essentially, since about the middle of last year, when inflation popped up as something we were all concerned about, the market, and for a time central banks as well, have been consistently betting inflation has peaked and it's going to fall away again very, very quickly. This is the premise of the US Federal Reserve, the most important central bank in the world. This is their premise for most of last year when they were out there talking about inflation being a transitory problem. We showed a couple of charts back in March, which I'll put back up again now. And this shows US CPI inflation. So I'm going to mainly talk about the US market. It's analogous to all developed markets at the moment, what is happening in the US, Australia included. And you can see up until about the middle of last year, inflation finally first popped up above 5%, first time in a very long time. And people, I think, first started to talk about this issue, take notice of it. And it's certainly when the US Fed started talking about this transitory issue that we had to worry about. However, the received wisdom by the markets and the Fed, for better or worse, was that this was an issue that was going to go away very quickly, that it would solve itself. This is a transitory problem and nothing we had to worry about. And we can see that by the forward curve at the time. So the forward curve is the market's expectations for inflation out into the future. So back in June of last year, this is what the market thought inflation was going to do. And just to say, these are big liquid markets. This is not a squiggle Emma and I put on the screen. There's hundreds of billions of dollars pricing that kind of that expectation out into the future. Now, if we move forward to March, when Emma and I were talking about this topic, we can see that inflation actually kept going up, not down. However, despite inflation continuing to shoot right up, the market continued to have this perception, this belief that we were through the peak. Inflation just around the corner is going to fall away again very quickly. This is nothing that we really have to worry about. And you can see that again by the new forward curve. So in March of this year, that's what the market thought inflation was going to do. So it's moved up and to the right. Crucially, and this is the theme I'm going to keep coming back to, the market has consistently been betting inflation is about to start falling very, very quickly. Now, about this time, the market's perception of the inflation problem and central bankers' perception of the inflation problem started to diverge. The Fed, the US Fed, dropped this notion that inflation was transitory, and instead they started to see this as a real problem they had to get out in front of. And that really changed their behaviour. However, the market, for better or worse, continued to have this bet that inflation had peaked. This is a transitory issue. It's going to fall away again very quickly. This is not something we have to worry about too much. And that diversion between what markets were thinking and what the Fed particularly was thinking in the early part of this year, that disparity is a really important point. I'm going to come on to that to the next slide. So just remember that about that time is when the polarity of the two views started to change. But just to finish here and just to sort of show the punchline, of course, inflation hasn't stopped going down. It's kept shooting up. And you can see the market's expectation today. Again, the market continues to think inflation is going to fall pretty much in a perfect straight line, back down to a level where we don't have to worry about it again in very short order. Inflation has actually fallen. So you can see the navy line, the realized inflation line, it's fallen. We've had 1 month where it's fallen, which has got the markets very excited. And that's been part of the big rally we've seen in the last few weeks. And maybe it is the end of it, and maybe the forward curve today is right. But I think the paradigm I'd ask you all just to keep in your mind as I keep talking is the market for a long time has had this bet. Inflation is about to end and it's going to go away very quickly. This is not something we have to worry about a lot. Now, inflation is a horrible problem for all of us. It's the silent tax. Money in the bank starts losing 5 to 10% a year. That's very painful. Our purchasing power all changes a lot. For financial markets, the main reason we worry about inflation is because of the impact it has on interest rates. Central banks, especially all the developed market central banks, have a mandate to keep inflation very low and very stable, importantly. And the main policy tool they have to achieve that is their ability to increase interest rates. That's why we're always obsessing about what the RBA does and on mortgage rates and things like that. This is another slide that we showed in March. And you can see, so this is US short-term interest rates. And you can see the slide takes you to realized US short-term interest rates until June of last year. So this is when inflation had just hit 5%, like I showed on the previous slide. The market was just starting to talk about inflation as a problem that maybe we need to pay a bit of attention to. And you can see the market was very, very relaxed about interest rates. That's the forward curve. So we're now looking at the forward curve for interest rates. This is what the market thought interest rates are going to do over the next sort of 5 to 10 years. And I think the key takeaway is they didn't think they were going to do much. So even though inflation is 5%, the Fed's talking about this as a transitory problem. Inflation, interest rates are expected to rise very gradually, and in the scheme of things, not by much at all. You can see that by March, as inflation wasn't falling, but it was rather going up, interest rates started to go up a little bit. And you can see the forward curve in March. And so again, this is when Emma and I are sort of having this conversation with investors just a few months ago. The market's expectation up until recently was still that inflation is not a problem. Yes, interest rates probably have to rise a little bit quicker. And you can see, the shape of that forward curve, the shape has really changed at the front end. So the market started to think maybe near-term interest rates have to go up a little bit. But crucially, longer-term interest rate expectations haven't changed. They essentially haven't changed much at all. Now, I said earlier that about this time, the market's perception of the inflation problem and central banks' perception of the inflation problem really started to change. The US Fed dropped the idea that this was a transitory problem and instead started to see this as a real systematic risk. You've got inflation prints now at 9-10%. They've got a legal mandate to keep it at 2%. They're miles from that. And their view of this as a problem really started to change relative to what the market was expecting. And I think the Fed, particularly, but most central banks realized they had to get ahead of this issue now. And the only way they could do that was to do some real heavy lifting on the interest rate front. And you can see the impact of that here with what happened to short-term interest rates. Kaboom. One of the fastest interest rate hiking cycles in history. And in terms of scale and quantum, like incredible. It's very strange to see interest rates shoot up that much so quickly. And as you can see, a few months ago, Emma and I were talking about this as an issue. We didn't at all think things would move quite this far, but the forward curve back then was that interest rates weren't going to do much at all. Now, it's a truism of finance that interest rates and asset prices move in opposite directions. As interest rates go up, asset prices have to fall. And this very large, very fast hiking cycle that we've seen in the Fed and in most central banks around the world has been the main driver of the large negative falls we've seen across most asset classes. Anyone that's been an investor the last 6 to 12 months will unless they've been very, very lucky, or perhaps invested in GBF, will notice that it's been a very painful time to be investing in the markets. To put some numbers around that, calendar year to date, so from the end of December to the end of October, global share markets and global bond markets both down 21%. In US dollar terms, in Australian dollar terms, probably more relevantly for us, down 11%. And the racier end of the market certainly fared a lot worse. The FANG stocks, the market darlings for a long time, off 40% this year. Price of Bitcoin is halved. It's been a very tough time to invest. And most of those large moves have been driven by this inflation and interest rate dynamic. Big hike up in interest rates has had a huge impact on pretty much all asset classes. And I'll just pause there to try and do a bit of Emma's job for her, but to give GVF a small plug, over the same period of time, the GVF investment portfolio fell 1.6%, so much more modestly. And in fact, shareholder total returns were up 1%. So share price and dividend, you actually made money. And just to finish off here, and I think this is the key point, this is the forward curve today. So you can see there's been an enormous shift in longer-term interest rate expectations. That's what's driven the big fall in asset prices we've seen this year. And the key takeaway is that the interest rate market now expects rates to settle much, much higher than we've seen in recent history. And this is the dynamic that's crucially going on in the market today. When you read in the paper about people hoping there's a pivot or pivot getting pushed back, it's all talk about, is the Fed going to start cutting interest rates? Is this dynamic going to start easing somewhat? So that's where we are. That's what's happening in the market at the moment. Where does that leave us? I'll start off by saying something that I'm sure I've said in most of these presentations, and I'll keep saying until investors don't want me managing the GVF anymore. But I don't believe for a minute we're any better at forecasting the future than the next guy. There's a lot of work into it. The markets are very efficient, and it's very hard to add value in these sort of macro calls. Rather, we have a very differentiated strategy, a process that we stick to regardless of the market weather, and a process now that's proved itself through 8 years, a number of market cycles. And that gives us a lot of confidence, hopefully, to believe that we can continue to make our own weather, regardless of what the market throws at us. Having said all of that, I think the thing that continues to worry me and the team is what Emma and I was talking about in March. Perhaps inflation really is about to fall like a stone from here. And in 6 to 12 months, this is an issue that everyone said it's gone and we don't have to worry about it anymore. And just to flesh that out a little bit, I mean, there are some really good reasons to believe inflation is going to start to moderate over the next 6 to 12 months. The most important one is just the base effect. We've seen these huge hikes in commodities like oil, but that's happened. And if anything, they're moderating now. So the normal lens you look at inflation at is on year comparisons. What's the price of petrol today versus what's the price of petrol this time last year? So 6 to 12 months from now, those year-on-year comparisons will work their way through the system, and we should start to see inflation fall. But because of this expectations issue, this feedback loop that Emma and I talked a lot about in March, this psychological aspect of inflation, I do worry that there's a real risk. This is going to take a lot longer to solve, and it's not going to fall in that nice, perfect straight line that the market's currently betting it will. At least that seems like a very plausible outcome to us. It's certainly a long way from a 0% probability. So in terms of how we're positioning the portfolio today for review, if the market is right, if the market is about to quickly disappear into the rear vision mirror, then markets probably are due a really big bounce. And I'll be honest, GVF probably won't keep pace with them, at least not in the near term. We'd like to think in the medium term we'll catch them up again. But if the market is right on inflation today, and it's been wrong for about 18 months, we could probably lag a nice bounce in the markets. We'll participate, but probably not to the full extent. We're very philosophical about that because we continue to believe that there's a real chance we haven't seen the market lows yet, that the market continues to be far too kind of glib on the inflation risk, and that there's a real risk that this hangs around for longer, is a harder problem for policymakers to solve. Fundamentally, I just find it very hard to countenance that it's going to disappear so quickly, such a hard problem. And if that's right, and markets continue to slide later this year into next year, I'd like to think that we continue to offer a great place to sit. And I say all that, and I think the good news, hopefully for investors, is when we look at the portfolio today, we feel like we've kind of hedged our bets in the portfolio. And that's because the opportunity set for what we do, the specialist strategy, is really, really rich again. We've had this big sell-off in markets this year that often provides a great opportunity for us. Things get cheaper all around the world, and you can hopefully see this in the chart here. This shows the UK closed-end fund universe. So we invest all around the world, but the UK universe is certainly one of the more important universes we invest into. The navy line shows the average discount for the sorts of funds and instruments that we invest into in the UK. And you can see that it's certainly been getting cheaper this year as markets have sold off. You normally find that to be the case. Markets sell off, you find more value. But the things that's gotten us really excited is that bottom right-hand corner. So the grey bands show the range of discounted opportunities in the space. And if you look at the moment, the bottom right-hand corner now, the place that we play is almost as cheap, and in some cases even cheaper than what we saw after the COVID sell-off in 2020. And that preceded for GVF probably the best run of performance we've had in a 12-month period. Now, I'm not promising that, I'm not even advocating that that's what's going to happen. But if I look at the portfolio today, I think what gives us a lot of comfort is if markets bounce, I'm very confident we're going to participate in a lot of that. If markets don't bounce, there's so much value in the portfolio that Mark and the team are really working hard to get that value out. But I feel we're in a really good position, whatever the market throws at us, whichever which way the ball bounces over the next 6 to 12 months. And I might leave there. I know we wanted to save some time for Trian. So on that hopefully optimistic note, I'll hand back to Emma.
Okay. We'd like to talk about a case study that has unfolded within the GVF portfolio over the last few years, and which continues to be an ongoing investment with an end date before 30th of June 2023. As a reference point, we are filming this case study in November 2022. What's a bit different about this example is the fact that this trade didn't quite go to plan. And it's the not going to plan part that is most interesting and hopefully highlights how the team managing GVF think about investing and managing the portfolio. Now, you may or may not have heard of Trian, the manager in this example, but Trian is a multi-billion-dollar alternative investment management fund based in New York. One of its three founders is a well-known and highly regarded billionaire activist, Nelson Peltz. If tabloid gossip is more your thing, Nelson Peltz's daughter, Nicola, recently married one of the Beckham boys. Anyway, back to the trade. Nelson Peltz has been a very successful investor over many years. He has proved very good at finding operating companies where he thinks he can run things better, engage with them, and turn things around. You may have seen him on boards such as Wendy's, Procter & Gamble, Mondelez, or most recently, Unilever. So when he looked at launching a UK company with the sole purpose of UK investors co-investing with him in a single target company, you can probably imagine that there were large UK institutional investors who were attracted to an opportunity to tap into the skill set of legendary investor Nelson Peltz. In September 2018, Trian Investors One Limited was brought to the UK market. The idea, as the name suggests, was that the company would be the first of many companies that Peltz would set up in the UK to accommodate individual turnaround stories. After Trian 1, investors would receive back their capital and they'd have the choice of whether to go again with Trian Investors 2, Trian Investors 3, 4, and so on. It should be said that late 2018 was a pretty tough time to IPO any company. The Federal Reserve was raising rates, equity markets were volatile, and when push came to shove, the launch of Trian Investors 1 was harder than expected. In fact, one of the investment bankers leading the IPO, Jefferies, ended up supporting the deal by purchasing a 12.7% stake at IPO to get the trade over the line. Trian's founders also invested quite a bit in the IPO, and we understand friends and family also helped Peltz get it over the line. By June 2019, Nelson and his team had chosen their target investment, Ferguson, a leading distributor of plumbing, ventilation, air conditioning, etc. across North America. Mark, perhaps you can tell us your thoughts about Ferguson and this first choice from Nelson.
Yeah, so to us, Ferguson made a lot of sense, and their thesis, which Trian laid out in a presentation not long after they built their position, seemed really sensible. I'd say the only surprising thing about the investment really was that Nelson Peltz & Co. got exactly what they wanted without having to actually join the board there. We can never know how much engagement there was behind the scenes, but to the outsider, it seemed like Nelson Peltz and Trian were pushing on an open door with Ferguson, with the company seemingly coming out and doing all the things the manager had talked about. So there's no doubt about it as well that the investment has done very well. Just to put some numbers on it, at the end of 2021, at the peak for the Ferguson share price, the Ferguson investment was up 160% in sterling terms over 2.5 years. And it's obviously given up some of that this year, but even today, the investment is up around about 100% over 3 and a bit years.
Wow, and there's a graph there in front of us illustrating how well that company has done. So the underlying trade in Ferguson works out really well in hindsight. That's great. But investors in the UK didn't buy Ferguson direct. Rather, they purchased the UK company Trian Investors One, whose underlying investment was Ferguson. It is this company that the case study is about, as Trian Investors One is what GVF invested into at a discount. With the benefit of hindsight, we can look at this investment of GVF's in 3 phases. To be clear, we never intended this investment to turn into a 3-phase trade, and that is what makes the story interesting. Okay, so let's begin. Phase 1. Mark, correct me if I'm wrong, but yourself, Miles, and the team started looking at Trian Investors One in late 2020. Tell us why you were attracted to the trade and maybe let us know the outcomes you were targeting.
Yeah, so as you pointed out, while Ferguson had done well, investors didn't own that. They owned Trian Investors One, and returns on that were nothing like this. And so a wide discount had developed. We'd been following Trian Investors One for some time, but first invested in late 2020, early 2021. And that was at a high 20s discount to our estimate of the asset backing. As you alluded to earlier, this fund was quite unusual in that it intended to go after one company and return capital afterwards. And the prospectus set out rules that said, at the very least, the fund would have to return the net profits of the Ferguson trade when it sold, or potentially, we thought 100% of the capital would be returned after Ferguson had played out. So while the timing of any catalyst was uncertain, there was a hard catalyst in place. And even assuming that they reinvested the initial capital after selling Ferguson, the net profits that we'd be getting back were at that time around 40% of the price we paid. And we'd be getting this back at asset backing, which was significantly above the market price. So we modelled several scenarios, but across those, we were estimating an average mid to high teens annualized return when we invested. And what's more, the underlying portfolio was extremely transparent, one stock, and hedgeable if we wanted.
Okay, so this was a classic trading position for us with a clear catalyst in place. The trade was understated, bread and butter business that we really like, correct?
Yeah.
But it didn't go quietly or understated at all.
No, unfortunately not.
Indeed. In May 2021, out of the blue, the board of the company came out with proposals that would renege on the key IPO prospectus promises, like investing into one company at a time and returning investors' money at the end of the trade. The new proposed investment policy also gave the manager huge latitude to invest into whatever they wanted with no limits, and they didn't have to return capital at all. Mark, perhaps you could talk to us about how you guys felt when this announcement from the board was made and what your initial emergency steps were.
I mean, we were horrified, to be honest, and very quick to let the board know how we felt. We also reached out to some of the other shareholders who it turned out were just as unhappy as we were. I have to say, we often speak to other shareholders in the investments we have, and it's rare to find such a consensus as this. Literally nobody wanted these changes. On the face of it, then, you'd think the proposal stood no chance of being approved. However, as you've mentioned before, both the manager and Jefferies, the company's investment banker, both owned large stakes from the IPO. So we feared this was going to be a very close vote, with independent shareholders on one side and the manager and the company's advisor on the other. But despite the fact that we and other shareholders urged the board not to allow a situation where the change was narrowly voted through by 1% or 2%, it fell on deaf ears, and the vote got passed 52 to 48. There was also a large percentage that abstained, which I think any other board would have seen as a protest vote. Now, 52 to 48 sounds close, but if you stripped out the votes that came from the manager and Jefferies, it wasn't close at all. It was 71 to 29 in our favour. This was clearly a change that shareholders opposed, being forced upon them by shareholders that didn't have the same economic interest. What was really particularly disappointing at this time was the board and manager's attitude after the vote. The chairman of Trian Investors One brushed off shareholders' complaints, arguing that we needed to respect the will of the majority. The manager likened the result to an election where we'd lost and needed to accept the result and move on. We felt the board was completely captured by the manager and was putting the manager's interests above all others. Almost 3/4 of the company's independent shareholders didn't want to be there, but the board and manager weren't willing to do anything about it. All that said, it wasn't clear to us how far shareholders would be willing to fight this, or rather, how far their compliance and legal departments would let them go with this.
God, what an impossible position to be in. I mean, a captured board, a narrowly passed vote, a manager taking a Trump-like done deal approach, and a disparate and possibly despondent group of shareholders, handcuffed by perceived compliance and legal risks. Yet you guys decided to keep going. All very admirable, but how did you decide between cutting your losses, which I know you astutely do when necessary, and continuing on with something that could end up sucking a lot of time and effort?
That's a good question. Look, from a risk management perspective, the thesis had changed, and you just couldn't deny that. Even if you thought the proposals might be narrowly voted down, our perception of the manager and the board had changed dramatically for the worse. We therefore felt we had to realign the position size within the GVF portfolio, taking into account the risk reward under the new terms. One of the advantages GVF has is its size and our ability to be fairly nimble. We were in a position where we could take the position down to a size that we felt comfortable with far easier than others on the register. Before the vote, we sold some of our investment into the company's share buyback at a circa 21 discount to asset backing. And that was quite a bit better than the level that we'd entered the trade. In discount capture terms, our returns would have been roughly 14% or so had we chosen to exit entirely there. However, the returns on the trade were actually much better because of how well the underlying Ferguson investment had done. It was around 60%. We partially hedged GVF's exposure to Ferguson, so we got something between those two. But we didn't sell the entire investment there. We got it to a level that reflected the expected upside and our estimate of the probability of success. Now, you're right to ask about the time that gets taken up in campaigns like this. And as you know, Emma, this campaign took a huge amount of time and effort from you, Miles, myself, and the rest of the team. The thing is, you just don't know in advance how great that's going to be. Also, the actions of the board and the manager, we felt were just so egregious that we felt we had to stand up for ourselves and other shareholders and for just basic principles of good corporate governance.
I hear you. I mean, on the time and effort angle, you can never know, as you say. That said, I mean, for me, the experience that myself, the team, yourself have gained from this trade has been invaluable. And I really do believe that it will tangibly build on the IP that we have, the intellectual property that we have within the business. Okay, so you resize the GVF position to the risk. Your motivations are clear. And let's be honest, that point you made about corporate governance is important. There's often so much hot air about all these corporate governance initiatives that firms are making, but we see little action. Here is a real life example where the corporate governance is atrocious. And instead of just walking away, which we could have done easily, we take up the task of rallying people around to stand up. And so begins phase 2 of the trade.
Yeah, and it was months of blood, sweat and tears, and nothing was easy about this case, starting even with getting a law firm to represent us. As you know, we spoke to 8 firms trying to find someone to help, but they all had conflicts or potential conflicts. Fortunately, in the end, we found a great lawyer that was conflict-free. Then it's about going around and speaking to all the other shareholders and coming to a decision on what to do. While activism is something we're very willing to do, for other investors, it's the last thing they want to get involved in. I think all shareholders wanted to give the board a chance to do the right thing and find a solution, and just different people had different processes to follow before they felt they'd exhausted all other options. Unfortunately, it was just clear to us that this board wasn't going to look after independent shareholders' interests, so we were going to have to take action. And we'd been speaking to shareholders one-on-one for several months, but we first got everybody together in a room in late 2021 to talk as a group. I'm fast forwarding a bit through a lot of work that was done by all the shareholders involved, together with legal advisors, communications advisors. But eventually we got to a stage where shareholders formed what was called an ad hoc committee. We agreed a course of action. And together, we requisitioned a meeting to remove all but one director, and that included the chairman, appoint an independent candidate, and to appoint Miles as a shareholder representative. But that's just where the hard work started. By that stage, the manager owned close to 30% of the company, much more than it did at the time of the 2021 AGM. A lot of that increase came from where it bought a large stake from another shareholder in late 2021. So together with Jeffries, it now owned around 43% of the company. So every vote was vital, and therefore the press releases we as a group published had to try and appeal to the shareholder we didn't know and hadn't spoken to yet. Now, to cut a long story short, the vote was a partial victory. The chairman was removed, and the independent candidate we put forward was appointed, but the votes to remove the 2 other directors and to appoint Miles were lost by the tiniest of margins. Now, we did a lot of work on this in the days that followed to figure out why this was, and without going into too many details, we felt fairly confident that if the vote had been called again, something I think we were willing to do, we would have succeeded in removing the directors and adding Miles. As it turned out, though, this wasn't needed. Soon afterwards, and I think they did this with the knowledge that we would have won the vote eventually, the board, which by then, of course, had a different chair and it had the independent candidate we put forward, announced that it had reached a deal with the manager to distribute at least 95% of the company's assets before June 2023, and then wind up the remaining assets of the company.
Wow, wow, what a result. God, I'm not sure I've ever been so chuffed, nor Miles. But how about you, Mark?
Oh, yeah, absolutely chuffed. And it was a great outcome, even better than we could have hoped, but one that, in our view, wouldn't have happened without the updated board and the fact that the independent shareholders had the votes to ultimately win.
Yeah, absolutely. I completely agree. Okay, so now while most of the shareholders were still celebrating, we saw a third phase of this trade. Tell me about phase 3 and why this turned back into that bread and butter type trading we love.
Yeah, so once the news came out that the fund would be distributing all its assets before next year and then winding down, it became a very different type of opportunity. It's more like a simple trade where you're locking in a 10 to 12 discount that you're going to be taking out over between 9 and 12 months. And this is the kind of trade we quite often get involved in. Therefore, we felt very comfortable making this a much larger position. Now, because we had a very deep knowledge of the situation, we were able to take advantage of this quickly. And in the first day or two after the announcement, we picked up a couple of blocks. And at the level we added, even if this takes until June, July next year, it's an attractive teens annualized return. And that's with the market risk hedged out, which in the current environment is pretty valuable. And in a way, this opportunity, phase 3, is a bit of a bonus from the situation. The other bonus, I'd say, was the relationships that we've developed with the larger UK institutions that we worked with on this. So it was a happy ending, but only because we didn't accept this change of investment policy. I think if we and the other shareholders we worked with on this hadn't acted, investors could easily have been stuck permanently in this or forced to sell at a huge discount. Instead, shareholders are getting their money back at full value next year. And I think it goes to show that sometimes activism is just self-defense and an important risk management tool.
Completely agree. Thank you, Mark. What a journey. And my goodness, what a great win for GVF and UK corporate governance.
Perfect. Okay, so we can move on to Q&A now, if you like.
Did you want me to start and then tag team?
Yeah, I can ask the questions. I thought maybe we start with the questions that were asked ahead,
Okay.
and then we can move to the room and then move to Zoom, if that's okay.
I'll sit here.
Yeah, cool. Cool. Okay, so number one, Michael Saunderson has said, have we seen the bottom of the S&P?
Well, I mean, I'm sure he's asking it a bit tongue in cheek, but as my father told me a very long time ago, no one calls the bottom, no one calls the top. I think how I would phrase it is, if you're a medium to long-term investor, we've had a big pullback in the market. That's never a silly time to invest into an asset class like shares or big licks like Argo, tremendous long-term track records investing in sort of generic stock markets. Whether we've seen the bottom or not, I don't know, and I think it will come very much down to that inflation interest rates dynamic. If I had to make a bet, and, I'm not positioning a portfolio like this, but if I had to make a bet, I'd say no.
Okay. Simon Cohen, please send me a scone. I'll see if there's any left. Thomas Warwick has said, I'm a shareholder looking to reinvest. Excellent. We'd love to have you back. John Thompson. Previous investor updates have referred to VSL giving shareholders the option of cashing out at NTA if certain performance thresholds are not met by 2023. How likely is that option that it will be triggered, VSL, and what impact would it have on the NTA?
So the VSL, and I'll try not to waffle on for too long, but VSL is a really important investment for GVF at the moment. It's one of our largest positions. It's one we've been engaged with over a number of years. And back in 2020, we had a similar sort of campaign as this, where we didn't think the board and the manager were doing the right thing by shareholders. We rallied a lot of other shareholders around. There was a strong consensus. This is not just us making trouble. It was genuinely a problem that we saw. And that ultimately ended up with the chairman and another director leaving the board, and a bunch of commitments being made by the company. I think the one that John's referring to is next year, the company has to redeem a quarter of its assets at NAV, and that's in place. So that is definitely going to happen. I think it's about 6 or 7% of GVF. So we'll sell probably 30 to 40% of our holding, maybe 20% higher than the current share price. We continue to think there's some serious challenges at the company. So we've been doing a lot of work there. And I guess I'd just say that we actually hope that we might achieve a better outcome than what I've just talked about. But as a baseline, there's a large return of capital, 20% above the share price today.
Okay, excellent. Michael Kent, in terms of shareholder returns, is there any thought to shift the balance even slightly away from dividends income to growth in the NTA so shareholders might see a little bit more capital growth?
So this is one of those really hard questions, and sort of you ask one shareholder, you get one view, you ask another shareholder, you get another view. So I'd ask all of you to please send, to me and the rest of the directors up. I guess, and Michael's a great supporter of us. I think he's been with us from IPO, and I totally empathise with where you're coming from, Michael. I guess there's two schools of thought. One is that we pay out a very high yield. I think we're paying out one of the highest yields in the market.
Yeah.
And that creates this sort of self-perpetuating goodwill cycle in the sense the share price seems to do very well. You pay a high yield, the share price behaves very well, and shareholders are happy if the share price is up. So, that's not a bad way to go. I guess the caveat to that is it also means the NTA never grows a lot because we pay everything out again. We listed at $1. The NTA today is $1.17-ish. And, we've made a hell of a lot more than 17%. We've just given it all back to shareholders. So there are certainly some shareholders that would like to see the dividend stay in the company, get reinvested and compounded. With the best way we've found to sort of marry that tension on the register is really to promote the dividend reinvestment plan that we did a lot of work on. So if you'd like to reinvest your dividends, you certainly just have to tick a box or email Emma and they will get reinvested for you. I mean, I think the best solution is really one that I've probably spoken about to Michael, which is perhaps, and this is not my view, we've got a full board of 4, but perhaps dividends grow slightly slower than the growth in NTA over time. Maybe the yield could come back a little bit without actually having to cut the dividend. So hopefully, as the NTA goes up, maybe the dividend grows a little bit slower. That might be a halfway house, but it's certainly something that I know on the board we don't have a perfect answer to.
And of course, franking credits are trapped if we don't pay a dividend.
And franking credits are definitely trapped if we don't pay a dividend. So it's something Chris always reminds us about. So it's an important issue about it. No one wants stranded franking credits.
I think also we're currently paying 9.4 cents per annum, which is really high. And heads up, Bell's report is going to be coming out listing, I think, the top 20 LICs in terms of their trading capacity and keeping at parity. And we are in that group, punching far above our weights alongside names like Argo and AFIC, exactly. So I do think that the yield is super important, but 9.4 cents is a lot, especially in this environment. Okay. Bill Blomfield said, welcome back to Australia. Thank you, Bill.
Thanks, Bill.
John Nichols, there was made about a rights issue, SPP, down the track last year at Canberra. Any progress or thoughts?
Well, I mean, so we're definitely on record saying we'd like to continue to grow the vehicle, but not by a lot. I mean, Emma's said consistently, I think 300 is the max we'd want GVF to get to in size, and we're 200 and a bit now, I think. But we're in no rush. And if there's a window where we can raise money, we certainly will.
Yeah.
I think recently we've been sort of bouncing at a small discount to a small premium. And I think, we'd probably want to see a consistent small premium before we came back to the market. And as always, if we don't see a window to raise money, it's not the end of the world, we won't raise money. But I know it's lovely to hear that some shareholders would like us to do that.
And that was it from online. Does anyone have a question in the room? Please.
I'm running a bit late, but I think there was a big increase in New Zealand banks' interest rates. Wondering, because it's all topical, whether you've got any thoughts.
So the question, I'm sorry, I know you've come a lot, I've forgotten your name.
William.
William's question was, we've just seen a big hike in the New Zealand central bank's interest rates, a 75 basis point hike, the largest one they've ever done. And, do we have a view on that? And how does that fit into what we've been talking about earlier on inflation? And I think it comes into the theme. So, I mean, the US Federal Reserve, to their credit, is always generally early. So they've been hiking rates very quickly. They saw this problem probably a little bit quicker than some of the other central banks around the world. Maybe you can remember the speed of the interest rate hikes in the US. A number of the other wealthy central banks globally are maybe a step or two behind. So I'd say New Zealand is in that camp, the ECB's in that camp, and they're catching up to the Fed in how quickly they're raising rates. The debate in the US now is whether they slow the pace. So they've been raising it at 75 basis points a meeting, And the big debate that everyone's agonising about is, does that fall to 50 or does it stay at 75? I think in the case of New Zealand, there's an element of just a little bit of catch up to where everyone else is. But it's tough. I mean, I certainly don't have a crystal ball. I don't envy the job of central bankers. I feel often they're a bit like directors. You do a huge amount of work and often don't get that much thanks for it. But it's very hard. There's a lot of data coming in. The data is high frequency. It's not, there's not a lot of clarity about how much weight you should put on it. And I think everyone's just trying to steer the ship around inflation as best they can.
Pleasure.
Hi.
The franking credit account at the moment, give you an idea of what 20 cents per share is at the moment?
Yes, so we've got 8 cents of
Can
franking.
you just repeat the question for the...
Oh, the question was, can we have an update on the franking within the company? Just a reminder, we have control over building the profit reserve, as you know, and we've got 24 cents there. With the franking, because we are we invest internationally, the only franking we get is from the tax that we pay, or occasionally if we have an Australian investment. And we have 8 cents at the moment, which means that we could cover the next year and a half. But as I said, hopefully, Miles, we've started FY 2023 off well. Obviously, if we do well, we'll pay more tax and we can get some more franking. But yes, it is something that we can't control. What we have gone on record and said is that in the event that we ran out of franking, for whatever reason, we would look to increase the dividend and use more of the profits reserve to ensure that we kind of stuck to that 9 cents annual dividend, if that makes sense.
It's always a really weird dynamic. So whenever we pay tax, Emma's like punching the air, going, yes, franking credits. I'm there going, I can't believe we're paying taxes.
Taxes are good.
I got the impression I you were thinking of winding back that dividend level. Can you give me an argument why you wouldn't want to get franking credits out the door as soon as possible?
No, absolutely. So I'd say the risk of us ever leaving stranded franking credits are de minimis, especially with Chris and Jonathan on the board. And just to put them in perspective, so we have 23 cents of profit reserve. 24, and only 8 cents of franking. So we're going to run out of franking much faster than we run out of dividends. That's always the issue for us, or has always been the issue for us, is finding enough franking to fully frank the dividend. So we'd never let franking disappear. And occasionally we'll do, we're focused on that as an
In the
investment.
past, we have paid a lesson.
No questions?
Oh, that's great. Everyone's happy. We should move to scones and canapes.
All right. Thank you very
Sorry
much.
for the
Thank you
online.
Thank you very much for making the time, guys. Appreciate it.
Thank you.